a very special guest, Nilesh Shah, MD of Kotak Mahindra Asset Management Company. Nilesh bhai, so good having you. Thank you for being in our studios, and at the onset to you and yours at Kotak and family, a very happy 2025.
Thank you, Nilesh bhai, and wish all the viewers of NDTV Profit a very happy new year.
Thank you so much. We are excited to have this next few minutes of conversation with you. Would love to understand, for somebody who's looking at the glass half full, there is enough reason to be worried. Q2 was bad. Q3 may not necessarily turn out to be great. Rupee is depreciating. There is an uncertain era of Trump 2.0 out there as well. How do you juxtapose all of this into a frame and then try and build out your picture for 2025?
So, if we look at President Trump, obviously we need to engage with their administration better. India-US partnership has always created win-win situation. We solved their Y2K problem. Until today, we would have given billions of dollars of lines of programming. There's no ransomware there. There's no cyber security there. There's no other risk. If they would have programmed this in China, what would have happened? Their efficiency has gone up. Their costs have come down. Their security is enhanced. Through collaboration with India, we also benefit. We have done the same thing in generic medicine. Can this be extended into other sectors? So we need to engage with US better, and I'm sure they will figure out which side the bread is buttered. Second, on rupee, of course, rupee is falling, but that's its destiny. With our inflation differential and productivity differential worse than our peers in trading group, the rupee will have to depreciate. But from 7% depreciation every year, now we are depreciating 2-3% a year. And we still have 4th or 5th largest FX reserves in the world. On the economy, yes, second quarter did came below expectation at 5.4%. Not many people expected it. But the third quarter is beginning on a good note. The festival season sales are up. The wedding season is in full bloom. And the government capex has picked up. So will 5.4% become somewhere between 6-6.5%? Looks quite likely. Most importantly, we care for corporate earnings. The first half earning per share for Nifty 50 is about 550 rupees. The second half expectation is 500 rupees because people expect 1050 to come for FY25. Now we all know second half is better than first half. क्या 500 रुपया नहीं आएगा?
Point well noted.
So the glass is half full or half empty. It may sound to be intelligent by sounding pessimist. But please remember, optimist makes money in the market.
That's very well put, because a lot of the conversations we're having right now, Nilesh bhai, and it's great to have you here to put light on them, is all about economy is slowing down, rupee getting weaker versus the dollar, foreign investors not looking like they're coming back anytime soon, corporate earnings a little shaky, and consumption a concern. You're saying all of this is being looked at with an over-bearish sentiment?
So again, you have to look at the data. Rupee is depreciating, but which currency is not depreciating?
Yeah.
Corporate earnings growth is slowing down. Okay, so do you expect even 500 wouldn't be achieved? And the best thing is to ask that pessimistic guy, are you willing to short Indian market for next 10 years? Unlikely he will say yes. Are you willing to short it for 5 years? Unlikely he will say yes. Are you willing to short it for 3 years? Unlikely they will say yes. If you're not willing to short the market and you sound to be bearish, then there's something wrong. We are not at all saying that these trends are not there. Economy did slow down in second quarter, but second half it will bounce back. Corporate earnings growth, of course the base has increased. From 4 lakh crore profit in 2020, we are at 15 lakh crore. Now, no one can expect that over next 5 years, 15 lakh crore will become 60 lakh crore. So, growth will slow down because the base has become bigger. But will the market continue to reward investors? Answer is yes. On a price to earning basis, India may look expensive, but on a price to earnings growth, India doesn't look that expensive. It is still somewhere in the middle. And investors will invest over longer term horizon. We tell people, please don't invest with 1 year view. If you are coming in equity, take a 5-year view. Second, have moderated return expectation. Last 5 years were exceptional, broad-based rally, 300 stocks out of 500 stocks almost doubled or more. Now that's not going to happen. The valuations are now at a fair value level. So your returns expectations will have to be moderated. You will have to invest for longer term. There will be volatility. We are down 10% and people say, oh, markets have crashed. China is at the same level for last 17 years. No one is complaining there. And if they complain, they'll be put behind the bar.
No, we're definitely not there.
17 years, no return, and people are happy.
Yeah.
Over here, we are probably negative return for 6 months.
If they're unhappy, we won't even know. So that's a China
and they
story.
can't even express. And we are down for about 6 months. And people are saying, oh, our markets have crashed. So we'll have to differentiate noise from the news. An investor can make money if they take a longer term view, ride the volatility.
Just on that point, I'll follow up on lowered expectations of returns. To what extent? What is the quantum of lowering expectations? And I ask this to everyone we speak to, because a lot of new investors who've come in the last 3 or 4 years have not seen this kind of a sideways market where there's no real action. They're used to a different kind of a pace. It's become a bit like rummy. So what happens to their expectations and how much do they need to be lowered?
It will have to be significantly lowered. One, our inflation has come down, so nominal return will fall. Second, the base has become big. So today people are expecting 20-30% return. They are most likely to be disappointed. The numbers will be probably high single digit to low double digit.
Interesting. So in which case, well, then the argument would be, Nilesh bhai, that the risk premium that equities should give versus a fixed income fund giving the kind of returns, would equities attract the same kind of flows? I mean, hitherto, domestic mutual funds have been the linchpin on which these markets have stood. Can that change?
So Nilesh bhai, my competition is with the cash. Now, if you keep cash at home, you don't make any money.
That's true.
That everyone knows, but no one believes. There are crores of Indians who believe कि पैसे झाड़ पे उगते हैं. In FY21 to FY23, total flow into mutual fund, including debt mutual fund, was 4 lakh crore. Increase in currency note was 9 lakh crore. I have to just go to those savers and convince them that cash at home is not going to give you any return. It's actually going to depreciate. And please walk over to mutual fund.
Okay.
If I can do that, my flows can double.
Got it. Okay. Okay. Fair call. In such a challenged environment then, Nilesh bhai, what do you think? I mean, people don't have nifty futures in their portfolios, right? Hopefully. And if that is the case, I'm guessing that even if the markets were to be stable, don't give dramatic returns, but there will always be pockets of outperformance based on earnings growth, etc. While you now look at the business side of things, what does the investor in Nilesh Shah tell him about where is it that the business growth will be very, very positive within themes, if you will?
So one, this is quality over momentum market. And in this correction, momentum has slowed down. It is market where valuations will make a material difference, because if you're fast growing company, but valuations are pricing even faster growth, somewhere the base will catch up.
Yeah.
So go from a reasonable valuation sectors or counters. Today, if you put these two things together, private banks, which haven't delivered return for last 3-5 years, valuations have been derated. Telecom, where price revisions are likely to happen. Rural focused consumer staple as Kharif and Rabi crop is likely to be bumper. And there are lots of Ladli Behna schemes. Pharma, because as your income level goes higher per capita, from roti kapda makan, you will go and shift spending to entertainment, healthcare, education, travel, tourism. So I will say go for quality companies across these sectors and focus on valuation price is what you pay, value is what you get.
Just last points are banks for the next 1 year. You talked about 10 years, 5 years, 3 years outlook. Thoda main shorten karungi 1 year. Banks, capital goods, or new age platform companies. How would you rank these three? 1, 2, 3.
So from a risk return point of view, if I see, it will be pure bottom up stories. There are banks who are exposed to microfinance, personal loans, unsecured loans, whose credit culture has not been good. They are unlikely to outperform.
Okay.
We see stress in microfinance, personal loans, unsecured lendings. And in this thing, men's will be separated from the boys. In case of platform new age companies, you have to bet on the winner. This economy, this digital economy, winner takes it all. The margin of the number one player will be 50-60%, number two will be 20-30%, third guy will be loss making. So you have to bet on the winner. And to be winner in this industry, you need access to deep capital. If you or your sponsors don't have capital, then you are unlikely to succeed. So go for winner, having deep pockets. Obviously, management and everything else do play a role, but focus on person who will become winner thanks to capital access and management.
That is for banks.
For the new age platforms.
Okay. And on banks?
Banks, credit culture will become very, very important.
Okay.
Avoid those banks who have higher exposure to microfinance, unsecured lendings, personal loans.
Private versus public in banks?
Bottom up, figure out who has better credit culture.
Okay, and if you can't figure out, then of course mutual fund sahi is always
Absolutely.
there. Are you optimistic about 2025? I know you've said you have, but...
So optimism is relative. If you're looking at 30% return, I am a deep pessimistic guy. If you're looking at reasonable return...
So what is reasonable?
High single digit, low double digit.
Okay, so between say 8 to 12.
I don't know what that number will be.
Yeah.
I have never been right in predicting those things in my whole life. Unlikely that it will change now. But again, you don't invest with 1 year horizon in equity.
Of course not.
And you follow the dharma of asset allocation. If market at 26,000, when it was expensive, looked attractive to you to invest, at 24,000 it has become more attractive. So you should be putting more money.
Yeah, and these are lessons that I think Indian investors, especially in SIPs, etc., have learnt over time.
Absolutely.
So they're unlikely to forget it anytime soon. Thank you so much, Nilesh Bhai, for joining us today. Fantastic to have you at our studios.
Yeah.
Thank you.
And season's greetings to you.
Season's greet.
Most importantly.